No one's afraid of needles, right?
Yo, woo. Ta sẽ đi bắn nhau mà thôi. Cái quạt cho mát coi. Tắt nhà coi.
Back on your feet, mate.
Someone's about to get shafted.
Thôi chơi cái này đi. Con này hồi máu đã hơn.
I can fix you.
Ôi phét hôm nay nó đang good afternoon cái sập. Ui sập vãi cả cứt. Ui ôi đâm sâu thế này. Ôi má mình vừa chốt non rồi.
Havoc scientist Dr. Prometheus defended their projects following the downing of his Blue Eagle helicopter, accusing GTI of trying to drown out the global applause that Havoc has received for their research. He added that Havoc's security and PR directors were too busy to
Cho tiếng
address
súng
the
to lên tí nhỉ.
Whatever the case, it's clear that
đấy.
reason is indeed reshaping the future. The question remains whether that future is one of a tech-filled utopia or a war-torn wasteland.
Bây giờ mình phải chiếm. Cái này mình thủ đúng không ta? Mình bên thủ hay mình bên công? Mình bên thủ à? Mình bên thủ rồi. Map này bắn lần đầu luôn.
Protect your sectors and hold your ground. They're going to come hard and fast.
Ây, là bắn mình chết đấy. Đây nghe vẻ nó hơi giật lag một tí nha anh em ơi. Tôi phải tắt hết mấy cái đối bẩn đi đã. Ê fan. Từ từ thôi fan. Đồ họa cơ bản thấp đi. Để cao nó lag. Ok đấy. Ê, không nào cứu hồi sinh vậy. Lao vào hang cọp, không lao vào hang cọp sao bắt được cọp. Ây da, địt mẹ. Cọp bắt mình luôn. nó lại như thế này? Ui đi, mẹ lái cả xe tăng rồi. Xe tăng bên mình à? Ừ, bên mình. Ui, đâu đấy? Cái game này có nhìn người quá.
The enemy is attacking objective Alpha.
Smoke barrage ready.
The enemy has suffered minimal losses. We must remain vigilant.
Ui đi, mẹ xe đến rồi. Ấy à? Cái lùng mà. Khắc nghiệt quá, khắc nghiệt quá. Đây là nó núp ở mọi nơi.
Hold the line. The new world
Ôi,
is
nó đẩy được
standing.
cái khu này của mình đó.
Back on your feet. Okay for this.
Đéo được, đéo tha được đấy. Mình chỉ dùng ở trong chiến hào của mình thôi. Ui, bắn cái ly này. Kéo gì đấy. À, bên tủ nó cứ bị khó anh em ạ. Mini 14 ạ.
Medic! Over here!
Be advised. Enemy troops are attacking objective Bravo 1.
Ui. Cái lục mà.
Allied forces are engaging at objective Bravo 2.
Đừng nhìn thấy tao. Trời má, sao nó nhìn thấy tao?
Percent of their forces left and is still strong.
Hello anh em.
Hold this sector.
Mày đặt dép vào luôn. Đấy, lấp kín.
Be advised, our forces have secured objective Bravo 2. Be advised, enemy troops are attacking objective Bravo 2.
Áo. Ê, cái gì vậy? Phái lổ nó bắn cung ạ. Đông quá. Giờ mình phải thủ cái B2. Ơ, thằng lồn chạy đây đâu? Mẹ em mày giật cá mình. Ây da, dưới bắn khét nẹt.
Allied forces are clearing objective Bravo 1.
Hồi sinh. Hello Quang. Quang bắn Delta Force không Quang? À, chúng nó đang chiếm B2 rồi. Để đi cứu B2.
Be advised, enemy troops are attacking objective Bravo 2.
Ôi chơi cuốn vãi cứt luôn này. Ui, thằng nào móc lốp tao nữa. Đù má, nó chui tận vào trong nhà này. Cái đấy là tải đi Quang đen ơi. Sang đây anh em mình chơi chung nè. Ôi, mình chiếm lại được B1 rồi này. Vào kết bạn đi anh em mình chơi chung.
Allied forces have taken objective Bravo 1.
Mày hoa đủ má có cái thật. Trời ơi, cái gì đấy? Phá lồn của xe tăng. Vừa mới giết được, móc lốp được thằng kia, xe tăng nó làm cho viên. Đi luôn. Mày tính lỏ không chơi được á? Sao... buồn chứ này. Đi còn mẹ xe tăng này, cái thế nhở? Xe tăng này OP quá. Nó tên gì? Nó top 8. Làm cái cạc đồ họa lên đi. Anh cạc anh có một bao nhiêu ta? 1660 à. À có xe tăng lồn này. Ui. Không ai nhìn thấy tao, không ai nhìn thấy tao. Ý, móc lốp, móc lốp, móc lốp. Con má mày. Không kịp được ạ, sao bọn này nó cứ quay linh tinh nhỉ? Đáng móc lốp đẹp. Tự nhiên nó quay ra nó nhìn ạ. Đéo còn ở đây, đéo còn khói nữa. Qua bằng tăng quá quá em lại cháy rồi à? Ừ. Tí còn cụt tay cơ, tí nó đang họp lãi suất nè. 9 giờ có kết quả, hình như có kết quả rồi hay sao á. Không biết là lãi suất tăng hay giảm nhưng mà anh vừa sọt. Đây này, này đó bên này này. Ê! Mẹ mày! Tự nhiên rút cái bình bơm máu ra. Mới mất mỗi lãi thôi thì ok mà, bình thường sao đó. Bên này đông này. Bên kia đông này. Cái map này nó khốn nạn quá.
Allied forces are attacking objective Bravo 1.
Cái map này nó quá khốn lạ luôn đấy. Góc này ngon đấy. Đắp vào khói đi. Đấy có người nha các bay. Đây có đạn không? Ấy. Ấy à, AT4 là cái súng đéo gì? Địch còn 25% quân lực. Ô, mình sắp thắng rồi, sắp thắng rồi, sắp thắng rồi. Ui, đến giờ vẫn còn thủ được cái cỡ như thế này. Đấy, đối diện đây có một đống này.
Strategic beacon ready to deploy.
Do not let GTI interrupt the Relink's development.
Đại ca còn soát ETH nữa không? Còn chứ, mới soát xong. Đẫm. Nó mới từ 3k7 về 3k6 ba mấy rồi kìa. Sơ tán à, sơ tán à. Thế nào? Đây, địch bên này, địch bên này. Đây, thẳng mặt có địch này.
Artillery barrage ready.
Đây, đó. Bố mày thấy chứ mày rồi.
Reloading! Cover me!
Ui, đâu đấy? Đù má sao nó đắp? À, máy bay. Máy bay. Cứu bé. Ôi, thằng cứu mình chết con mẹ rồi. Thằng cứu mình lăn ra chết ạ. Cảm ơn lòng tốt của bạn. À, không kịp. Đúng rồi, chỗ hớ hình quá. Nó vào tận nhà rồi, đéo biết. Đấy,
You
cảm
saved
ơn.
my ass!
Ơi, đâu đấy? Trong nhà kìa các bé ơi.
Enemy has taken objective Charlie.
Coi nó vẫn đang tăng mà bé. Coi nó vẫn đang tăng mà quang đen. À, bao nhiêu con nó bay thế rồi. Ui rồi ôi. Ôi, con này anh chốt ở đâu nhỉ? Con này anh chốt ở đây thì phải. Anh chốt ở đây. Nick RP anh chốt ở đây. Zone mình lại chốt ở trên này. Zone mình chốt mãi trên này. Đây. Ui. À, trên mái nhà bảo sao đéo núp được. Ta muốn vào vùng chiến sự.
I'm in for ya! Bring it out!
Ui, bom. Game cấp 20 nhưng mà hay. Ấy, sao đằng trước cũng có, đằng sau cũng có vậy? Cấp 20 nhưng mà nó hay quá. Nó hay quá nên là anh phải chơi. Ôi, lùi vào tận chỗ này. Không sao.
Defend this sector, whatever it takes.
Nó đạn cứ bay sượt qua đầu đây, đéo biết ở đâu luôn. Bị phòng thủ à? Đấy, quay lại, đéo được đi vào đây, đây là vùng của địch. Ui rồi. Ui rồi. Chạy được các cháu ơi. Ôi ôi. Ôi ôi. Đau quá. May mình chơi con hưu đi.
We cannot lose this critical objective.
Ê! Hồi máu. Ôi, cái xe đi qua đéo nhìn thấy mình, hay quá. Ôi, không thể chống được, quá đông. Mình đã làm hết sức rồi. Tao phải lao vào vùng chiến sự. Bên nào nhỉ? Bên này thì phải. Bên này, bên này, bên này, bên này.
The key objective must remain in our hands.
Đâu? Chúng mày thoát đấy. Thò vào thì tao vào tận nhà chúng mày luôn à?
The enemy is more than halfway defeated. Keep guarding the sector.
Ôi, vào đi. Ê! Ôi, hết đạn, hết đạn, hết đạn. Đại ca Lanh Lía, anh mới binh nhì à? Anh mới chơi buổi chiều hôm nay á. Buổi chiều hôm nay anh chơi được 3 trận đúng không anh? Hoa mắt, chóng mặt, buồn luôn. Xong bây giờ ok rồi. Bây giờ thích nghi rồi. Chiều nay phải nói là đủ mã mà anh say luôn.
Be advised, enemy troops are attacking objective Delta 2.
À, dạ.
Guided missiles launched.
Cái gì đấy? Ôi kìa. Ôi, lẽ là mình để cái màn kia nó che hết à? Ôi thằng 4 anh gom xoay không? Anh có đánh support đâu mà anh gom.
Allied forces are engaging at objective Delta 1.
Móc lốp, móc lốp, móc lốp.
Guided missiles launched. Roger that. Artillery barrage incoming.
Ui, đâu đấy?
Enemy forces at low capacity. Carry on. Copy. Vehicle drop to target location.
Artillery barrage ready.
Ui, kia tỉa gớm thật. Ây da, tao vừa mới dậy xong. Đây, các bạn Hiền ơi, lại cứu mình được không? Ôi, đéo được rồi. Địch kè mông này. Ôi, thằng này đang định cứu. Đéo chạy kịp, đéo chạy kịp. Bé ơi, bé ơi, bé ơi. Bạn yêu ơi. 4 bạn yêu. 4 bạn yêu ơi. 4 bạn yêu ơi, cứu mình ơi. Dỗi vãi luôn, đéo cần cứu nữa. Bố bạn yêu đéo cứu mình. Ui, một quả bom nổ vãi bìu.
Allied forces are taking objective Delta 1. Reinforce fire support.
Đâu nữa? Mẹ mày. Móc tận ra đến đây ạ. Mấy bạn yêu cái đéo biết bị nó giết mẹ mà. Ui.
Stand one.
Be advised, enemy troops are attacking objective Delta 2. Copy. Vehicle drop to target location. We have nowhere to retreat. Take back our line.
Các bạn yêu ơi, nó vào tận trong nhà rồi. Đi tại kia làm giả xác chết à? Nó làm yên, nó giả xác chết kìa. Trong nhà này nhá, trong nhà có một thằng nhá. Nó giả xác chết đấy các bạn yêu ơi. Ây! Má, hai thằng đồng đội với cả địch đi qua ngang qua nhau. Nhìn có tên tưởng là đồng đội. Đâu à?
Guided missiles launched. Our forces have taken full control of objective Delta 2. Let's go for the next objective.
Trời ơi, đông thế. 3-4 thằng nó phi ra.
Be advised, enemy troops are attacking objective Delta 2.
Sao nằm xuống ta? Đéo biết, đéo nhớ đút lằn là đút nào anh em ơi. Ghê lắm đồ chơi đấy. Kìa các bạn, xem mặt tôi.
Smoke screen incoming. We've held the
Thắng rồi.
line and the sector is
Thắng
secure.
rồi.
Operation complete. Well done.
À. Rồi. Binh nhì 1, đó lên hạ sĩ rồi nè. Quá đẳng cấp. Đây có cái gì miễn phí kìa bay ơi. Đặc vụ. Có chế độ gì khác nhỉ? Điều hâu gãy cánh này. Cái này là chế độ gì ta? Thôi đợi tải một tí anh em ơi. Tôi đi vệ sinh phát. Trường nghĩ đấy.
Requirement that's also uniquely applicable at the GSIB IDI level, which is just not aligned with the general framework that we currently have. And so it is important to balance what's at the holding company, what's at the bank. And as I was expressing earlier, I think this rule would strike a better balance, but that doesn't mean
Đây em ơi,
that going
Fed nó đang
lower is
họp đấy.
forever going to be a better thing. It's that it's necessary to balance all these things. So it's that this rule strikes a better relationship with the
Tắt
broader
game
framework,
ra tí nhá.
in my view.
Okay, I'm watching for hands. I'm also watching the time. We have a couple more minutes. Yes, now
Em
Al.
coi Fed tí.
Sure. Thank you. Al Moffat, JP Morgan Chase. So there's been a lot of discussion just early about the role of the leverage ratios as it relates to the Treasury market. And one thing I haven't heard from the panel is the effect on deposits. And so one of the things we saw during the periods of QE was that there was significant growth in deposits prior to the Fed rolling out the overnight RRP program. And strikes me that the changes to the leverage ratio may, reshape that into a potential next crisis. So I'm just wondering if the panel has any thoughts on the role of, particularly the value of changing the SLR for the
Nãy giờ anh á,
IDI
anh lỗ vãi cả cứt
and
ra
the
Quang Đen
consequence on
ơi.
deposits and other low-risk activities like
Nó đang nói
that,
chuyện.
even if they are put into cash and not 30-year Treasury bonds. And just, maybe that potentially offers flexibility for the Federal Reserve in the size of the RRP program. But welcome any thoughts.
Who has a thought about this?
Agree. As you mentioned, Al, heightened cash balances, heightened deposits, particularly and banks having the ability to support that in periods, particularly volatility or stress, is important. And I agree that both supplemental leverage ratio as well as the Tier 1 leverage ratio should also focus on that.
Anh check cái bọn Forex một cái à.
Yes, and I think just to reinforce that, making sure the leverage ratio doesn't impede the banking system when the Fed is doing QE and adding to those deposits that you were talking about. And that's at the Bank of England. We exempted deposits at the Bank of England when we wanted to make sure that was. So I think, as I said, I would be opposed to exempting Treasuries blanket, but I think thinking about exempting deposits at the Federal Reserve from the denominator, along with the other things, is worth consideration.
And that's a good point in that the PRA has made that exclusion as well in their leverage ratios, specifically for cash.
Good morning to everyone, and welcome to the Federal Reserve Board. I'm very pleased, though not surprised, to see such great interest in the topic of today's conference, the integrated review of the capital framework for large banks. And I want to thank Vice Chair for Supervision Bowman for having the great idea of holding this event at the outset of her term. I'd also like to thank Fed staff for their tireless work in putting the conference together. So today, we'll hear the perspectives of industry veterans, academics, and current and former policymakers who are all well-versed in the operations of large banks and the main pillars of the capital framework. A great benefit of this conference is the chance to consider all elements of the capital framework in concert, rather than look at each in isolation. We need to ensure that all the different pieces of the capital framework work together effectively. Doing so will help maintain a safe, sound, and efficient banking system for the benefit of the people we serve. The U.S. bank capital framework includes risk-based capital requirements, leverage requirements, the surcharge for the largest and most complex banks, and the stress tests. We will discuss the status of each of those elements and the road ahead in a comprehensive manner today. As this audience will know well, we have proposals outstanding or in the works across all 4 areas. Our regulatory capital framework and all banking rules are implemented through supervision.
Tất cả những người Việt Nam mà chơi Forex á, thì cái bên broker ấy, nó chỉ là bên trung gian thôi. Mình nạp tiền cho nó, tức là nó sẽ cầm tiền, nó mở lệnh theo lệnh của mình. Còn đâu cái số tiền nó hiển thị ở trên cái tài khoản MetaTrader của mình á, nó chỉ là một cái số tiền ảo thôi. Nó không có ở trên blockchain. Nó tiền thật thì bọn broker nó cầm, nó đi đánh cho mình rồi. Kể cả cái chart của chúng nó cũng là cái chart của nó dựng theo cái giá của quốc tế, và nó muốn vẽ như nào thì vẽ thôi. Và cứ kêu bên Forex ít bị điều khiển giá, nhưng mà anh thấy á, chẳng khác mẹ. Nó không điều khiển giá được bằng tiền thì nó điều khiển bằng tin tức.
Open to hearing new ideas and feedback on how to improve the capital framework for large banks.
Than risk weightings. And at the time, risk-weighted standards only accounted for credit risk, not market, operational, or interest rate risk, which was also an important part of thinking about bank capital.
Bởi vậy cho nên là nạp
But we're far along now in the process. Here we are in 2025. And risk-weighted standards have evolved during this period of time. They have since their beginning been supplemented to incorporate market risk and operational risk, and now incorporate complex modeling that did not exist at the time of Basel I. Moreover, interest rate risk is continually monitored by bank examiners as part of the supervisory framework and could be incorporated into risk-based capital if you wanted to do that. We also have several other safeguards in the capital framework that did not exist at that time, like the stress testing regime. So there are strong arguments that the concerns that motivated the retention of the leverage ratio have been mitigated by subsequent enhancements and refinement of the overall capital framework. The leverage ratio is now a frequently binding requirement for the largest institutions, meaning that it requires more capital than the risk-weighted standards. This is inconsistent with the agency's original rationale for retaining the leverage ratio, which was that it would sort of be a backup for the insufficiency of the risk-weighted requirements. Bank capital levels, in conclusion, Harold, are at all-time highs now, well above what Basel and other jurisdictions required. I think we need to step back at this point, which is the whole purpose of this conference, and ask ourselves, with respect to the leverage ratio, not only focus on ESLR, but whether we need it at all. Thank you.
Thanks. Does anyone want to react? What about the issue of intersecting types of capital requirements? Does that cause problems when different banks are subject to different rules at different times? Any views on the panel?
Well, I can offer two observations about the role of the leverage ratio in the broader framework.
Má đưa hoài vậy.
Stable, but the leverage ratio itself can't overcompensate and make up for any weaknesses in other areas of risk management.
Hal, did you want to react to anything, any of the reactions to your comments?
No.
No? Okay.
Vui đấy, họp vui đấy.
Sense a degree of alignment on the panel on this. Okay, Tiffany, you're the Treasury market expert. And as I mentioned, there's been a big focus on the unintended consequences for the Treasury market of this rule. So regulators have cited, in fact, in the proposal, Treasury market functioning as a key reason to recalibrate the leverage ratios. But is it better to lower the leverage ratios embedded in SLR or ESLR and the Tier 1 leverage ratios? Or would it be better to have a more targeted fix to address Treasury market functioning, like exemptions?
Thank you, Daryl. And let me kick off by thanking Vice Chair Bowman and the Federal Reserve for bringing us together today on this important topic. Let's spend a moment on Treasury market functioning. As a treasurer, that topic is so critical. We use treasuries for liquidity management, collateral hedging, and it's all linked to the Treasury market being the biggest, deepest, most liquid bond market in the world. Stands at close to 30 trillion today and growing. So supporting a resilient Treasury market is important for the broader financial system, which we're all invested in. There are two key tenets to that. One is safety and another is liquidity. In terms of safety, there are a range of enhancements already in flight, including the central clearing mandate. In terms of liquidity, supporting and deepening the market for Treasury securities, which is growing, is critical. In our seat, knowing that a Treasury security can be converted to cash easily, quickly, and in all market environments is so important. And that's all predicated on an ecosystem of buyers, holders, sellers, intermediaries. Treasury is particularly
chắc là chơi con bò nó không bỏ rồi. Bỏ con bò rồi. Chuyển sang làm đặc vụ rồi. Ui, bay vãi luôn anh em ơi. Bay vãi cả đái rồi. Bay tùm lum rồi. Lên 203 này.
This is what all my training's been for.
October 3rd. Intel confirmed ID's top brass were meeting near the Olympic Hotel.
Why are they burning tires? Signals to the militia that we're coming!
Jumpers, proceed to the landing zone.
Roger that.
Roger.
Roger.
About to enter Holodag Road.
1 minute. Entering militia-controlled territory.
Roger. Visibility of the target area is poor. You're on your own to find the landing site.
Received. Once we enter the market! In position. Requesting permission to land.
Jurisdiction point cleared for landing.
Cleared for landing. We need to get closer to the target zone! I'll try! C2! I need to put the bird down!
Star 4-1, cleared for landing.
Roger that! About damn time.
All units, when you're on the ground, establish your perimeter quickly. We've only got 30 minutes, so move fast.
We'll cover the high ground. You guys take the streets. Hostiles in the building. Check your corners.
This is McKnight. Uniform 6-4 approaching the staging area.
This is Super 6-4. Troops deployed.
This is Super 6-2. Troops are on the ground. Super 6-2, take up overhead pattern.
No one's afraid of needles, right? Have a shot of this, mate.
We have done everything in our power to reveal Havoc's motives to the people of Asara. We exposed their ploy to restore the dam in order to station troops in the area. We uncovered the truth behind the destruction of the dam. We proved that Havoc has devastated Asara for their own gain. But Havoc doesn't seem to get the message. Today, we'll use firepower to make it clear. They're not welcome here. Capture each sector and the enemy will have no place to hide. Allied troops engaging at Objective Alpha.
Barrage ready.
I need help! Medic! Over here! Someone help! Enemy neutralized! Yeah!
Allied troops neutralizing Objective Alpha. We have no forces left. Keep pushing and breaking through the enemy defense.
Oi! Need a hand! Need aid! I need help! Someone help! Draw in the curtain!
the arguably anomalous role of the 6% bank ESLR requirement in the current prudential framework. That's a bank-level capital requirement that's calibrated to be higher than for the holding company, but based on the GSIB status of the parent. It's actually the exact opposite structure of the GSIB surcharge itself, which of course applies only to the holding company. Second, there would be more consistency in the overall design of prudential standards with a focus on the holding company. And third, there'd be more alignment with the resolution planning framework, and in particular the GSIB SPOE resolution strategy. Under that strategy, in the event of failure, only the top-tier holding company would enter insolvency proceedings. The subsidiaries would be resolved without entering into their own separate proceedings. That strategy depends on flexibility, specifically flexibility for the GSIB to provide capital and liquidity to the subsidiaries based on their needs and resolution from centrally available resources. The strategy, of course, also depends to some degree on prepositioning, which entails having some capital and liquidity already at the subsidiary level. It's a balance between the two. So the proposal would therefore have greater consistency with the structural focus on the holding company. There'd be more alignment with the resolution strategy for GSIBs. And from that perspective, there'd be the perspective to potentially have reduced fragility and stress, promotion of the resolvability of GSIBs, and therefore positive financial stability implications.
Thanks very much, Ben. What about other reactions? Is the fact that the dollars of reduced capital at the holding company is small relative to the depository institution, is that important? Is there sufficient flexibility in capital in the structure of a bank holding company and its subsidiaries? What are your views? Hal, do you have a thought on this? Do you have a thought on this, Hal?
Yeah, so as you said, Daryl, the reduction of the depository level was much higher than the reduction at the holding company level. But I think we need to keep in mind the basic framework in which the holding company of a bank has to serve as a source of strength for the bank subsidiaries. So even though you are reducing the capital level of the depository institution subsidiaries, you have the holding company still with this obligation to support the subsidiaries. So I'm not that concerned because the holding company capital is not being reduced by very much at all.
Don, thought?
Yeah, so I agree. The fact that the holding company capital is basically unchanged is reassuring. I do wonder about the source of strength thing, though, Hal. I mean, once the capital is upstream from the depository to the holding company, downstream to the broker-dealer, or if it's not downstream, the broker-dealer won't do any good, right? So presumably the intent of the authorities is to have it downstream to the broker-dealer. Then you have a crisis. You have something happens that no one's anticipated. Are they really going to take the capital back from the broker-dealer and give it to the depository institution? In 2008, the board was asked to vote several times on exemptions
I can fix you.
upstream capital from the bank to the holding company to support the broker-dealer. So I think we need to think more carefully about whether the holding company would be actually a source of strength in a crisis situation.
Tiffany.
We have a responsibility
I think that all folds together to the fact that each bank is managing to multiple risk measures, capital being one, but liquidity, interest rate risk, and other measures will also support both the IDI as well as the holding company. So all of those various constraints ultimately inform how much could potentially be upstream or not. So there are additional constraints as part of a holistic risk framework that we are thinking of as well.
Thank you, Brian.
Yeah, I would just add, to Ben's point, the resolution framework for a single point of entry is meant to capture sufficient liquidity and capital at the intermediate holding company to avoid the situation that Don is talking about. Can it effectively do that? It's not clear. Disclosure's not great in that area. So another area where it might be helpful to have more robust discussions around that to give more confidence to more participants that actually could work.
And that's about resolution.
Guard your sector. Keep attacking until they retreat.
It would be nice to prevent the failure.
Ben, did you have a remark on that?
My only observation is I did refer to reducing fragility, and that's part of the benefit of having greater flexibility. Implicit in that reference to fragility is the possibility that the point of non-viability is higher in 2008. It's also, again, a reason why I think it's beneficial to consider the capital framework alongside the resolution framework.
Very complex topic. Don, I want to turn this to you. And you have been an advocate for reducing the SLR in order to make sure that it remains a backstop, as we've discussed, and doesn't impede the willingness of dealers to make markets in treasuries, as we've also discussed. But you've also noted an important caveat, that any adjustment does not reduce resiliency of the banking system. So when you look at the agency's proposals, how does it stack up against these criteria that you have in mind?
Thank you, Daryl, and thank you for inviting me to be part of this panel. to the Vice Chair. So you're right, I've long supported enhancing Treasury market liquidity by making the leverage, the SLR, a backstop. In fact, a senior Federal Reserve official told me a couple of years ago I was using too much of my brain space on the leverage ratio. So I'm grateful to have that space freed up for something else. But as you know, my support has been couched in the context that it not reduce overall capital requirements. And I think I take quite a bit of comfort from the fact that there's no reduction in the holding company level. But I do think, as I just noted, there are things we need to think about. And I still have a few concerns on this overall resiliency issue I'd like to surface, and I hope come up in agencies' consideration. First, obviously, making the SLR a backstop puts extra pressure on sound risk-based capital requirements. And I think financial sector resilience is especially important right now. The economy could well be on track for good growth and low inflation. That's what's priced into financial markets. But we shouldn't be lured into complacency. Secretary Bessent last night worried about pro-cyclicality in financial markets. He cited private credit in that regard. But we know banks and bank regulators, from history we know banks and bank regulators are not immune to this particular disease. And the tails of the distributions around the central tendency seem unusual as we are in uncharted waters with respect to the evolution of the trading system, the ratio of national income, and challenges to the independence of the Fed. Unanticipated developments are particularly high risk. And it would be preferable to evaluate this proposal as part of a holistic review of all capital requirements. In that respect, this is a bring all this together. There's so many in the risk-based capital, the Basel III endgame, the stress tests. How are they all going to fit into this? So were risk-based capital requirements the first line of defense? For reducing the backstop, and I urge the agencies to put the whole package together before signing off and in one piece. And the second point, I want to come back to something that came up before, and that is releasing capital at the DI will not reduce the resilience of the overall organization, but it will be encouraging. In fact, one of the benefits cited in the thing is encouraging banks to buy Treasury securities, so it does expose them to added interest rate risk, widespread losses on Treasury and agency securities contribute not only as problems, but the risk to the broader system that triggered extraordinary actions by the authorities in March of 23. The bank should be required to mark securities in the available for sale portfolio to market, and the available for sale portfolios should be subject to market risk capital requirements. Bank interest rate risk management, even for the hold-to-maturity portfolio, should be subject to close scrutiny. And as I noted, my concern about interest rate risk would make me very reluctant, would make me opposed to exempting all treasuries.
So the gist of your remark is that you want to see the whole package before a final view on it. Yeah, interesting. And other, Hal, what's your view on this?
So I think we need to keep in mind that the U.S. banking system is today very well capitalized. U.S. GSIB actual capital levels have increased 17% over the past 2 years, and our minimum capital requirements are now 1.7 times higher than the Basel requirements, 837 billion versus 473 billion under Basel, because of our stress testing gold requirements. This proposal does not reduce risk-based capital. It merely moves leverage into the background where it always has belonged, and in my view, we could do away with. Okay? And if it's in the background, you can further say, why do we need advance? It's not in the background, it's not right. Okay, so anyway, I think overall the U.S. banking system is in a very good place today in terms of its actual capital.
Hal, you mentioned gold plating. I'd like to get a reaction to something that came up, another topic that came up at dinner last night, which is the implications of the SLR and other regulations on the ability of U.S. banks to compete with non-bank financial institutions and with international banking institutions. First, is that competitive angle, does it figure in your minds as an important aspect of the rule change? And secondly, is it actually true that U.S. banks have been at a, or GSIBs have been at a competitive disadvantage because of the capital requirements that we've been discussing?
Quite frankly, don't know the answer to that, but I would be skeptical. I think there are a lot of other factors that affect competitiveness. I mean, when we originally adopted Basel, it was because of the competitiveness in terms of so we get them on an even playing level, they'll have to have the same capital. But then it turns out they have different accounting systems, they have different they have different forms of regulation, they have nothing to do with that. So you have to have all of that into the picture when you're thinking about competitiveness.
Any other reactions to competitiveness? Ryan.
Certainly, we have a higher SLR requirement than other jurisdictions, although that does not seem to have stopped our banks. Banks, I think certainly non-bank financials have significantly increased their scale and scope.
Get up and fight back!
Moderators don't get to vent their own views, but it does seem like better capitalized banks are better able to compete in principle.
Yeah, that was the point I was going to make. I don't think the UK, European, Japanese banks would think that they're at an advantage because their capital has been gold-plated. I think the banks are pretty much competing very, very well in the international field, and there are times when being well capitalized, having high capital is to your advantage because, of course, under stress, there's much less to worry about. We saw that in the U.S. in the March 23 situation where deposits fled from regional banks where people were concerned about the embedded losses on treasuries.
All units, defend the key objectives.
To the GSIBs, and some of the commentary, well, that's because the GSIBs are too big to fail. But I think it was also because the GSIBs were much better capitalized.
Okay.
Make one observation, which is that you receive a lot of questions about the regulatory capital or liquidity treatment about particular transactions or products and things of that nature. And that does clearly illustrate that they're marginal incentives and essentially what the marginal capital cost, liquidity cost does factor in. That's not necessarily contradictory, but I think it does show that that actual marginal effects of regulation do factor into business decisions. And there are differences between U.S. and non-U.S. requirements.
Tiffany, at a global bank.
Well, I was going to re-highlight some of Don's points. One, the really important interest rate risk management. Strong pillar is an important pillar, as I mentioned, is an important part of the overall risk management framework for me. Second, the holistic review is an important point as well because we find that, again, managing to a lot of risk measures, making a change to one risk measure is likely going to have another become binding over time and could have the same constraints, let's say, on the treasury market. So I think that holistic review is also makes a lot of sense.
Terrific. Okay, I think we got a pretty good sense of the views of the panel, and I think it's time to turn to you all. If you have a question, would you raise a hand? I see there are microphones. Would you also please identify yourself and try to keep it to a question, just one. We have a second.
Overload activated!
not a speech, just a question.
My name is Guo Wei Zhang. I'm in SIFMA. My question is, as you know, currently Category 1, 2, 3 banks are subject to 2 leverage ratios. One is supplementary leverage ratio, the other one is Tier 1 leverage ratio. And the question is, why do you think 2 ratios, both target leverage, are needed for these banks?
Okay, I'm going to ask anyone that can address that question, because I don't want to handle that one. Hal, do you have a thought on that?
I'm not going to defend one of 2 ratios when I disagree with both of them.
There's nowhere to retreat. Do not let this sector fall.
Aid on the way!
I'm watching for hands.
Be advised. Enemy troops are attacking objective Charlie 1.
I'm sure I'm shy of more than saying. Actually, I'm looking directly at John. You mentioned that you think that we should have a council. You mentioned that it was something that made sense in the UK, but at the same time, the US has an inclusive seat purchase, which does give you an ability to build capital.
I'm ready for another fight!
And so I'm curious as to why you would want to protect
The enemy has suffered minimal losses. We must remain vigilant.
So it's almost as though the concept behind having overlap is not.
There's nowhere to retreat. Do not let this sector fall.
So I certainly think there's simplification of the 2 leverage ratios and overlap between things. That's why this.
Some research, for example, by Paul Breining and Hilary Stein at the Federal Reserve Bank of Boston, showing that those dealers that were relatively more constrained by SLR provided relatively less liquidity to Treasury markets in the March 2020 event. And more recently, a Federal Reserve Board study by Mary Tian and her co-authors showed that those banks that have more headroom under the supplementary leverage ratio provided more financing at Bill's point in the Treasury market. So there is some research in support of what you're all saying. Other... Yes,
I'm injured! Need help!
So I understood the question basically was, let's get rid of the Volcker rule so we can have more prop trading that could actually help the Treasury market. That's the implication. Okay. So, I understood why we did have the Volcker rule. It was kind of a populist measure back at the time when Scott Brown got elected in Massachusetts. So I remember the Senate hearing on this and the Democrats being puzzled about why we were even doing this. If prop trading would help the Treasury market, I would be in favor of re-examining the Volcker rule. But I want to caution everyone as we talk about all these changes, there is legislation to consider here. This is not something that the Fed or other regulators can easily do on their own. A lot of these changes are embedded in statutes. Okay. Now maybe the president can be creative with executive orders in this area, but as we proceed on this line, we have to ask ourselves, how much can the regulators do without legislation? That's the constraint in this picture.
Just to be clear, in the legislation, the Treasury market is exempted from the Volcker rule, so it doesn't really restrict proprietary trading in the Treasury market. So let's have another question. Is that true? Treasury securities are not exempted from the Volcker rule? Al?
Daryl. Sorry. Norbert Michelle Cato. Hi. Sort of an efficiency question along those same lines. If we're worried about specific activities, okay, and if we're worried about source of strength actually being source of strength at the holding company level, why aren't we more worried about
There's nowhere to retreat to.
as opposed to
Do not let this sector fall.
So let's revisit that. Anyone have a reaction on this issue of capital at the insured depository versus the holding company? Ben, you had your...
Yeah, I think capital at the insured depository institution level is a relevant consideration, but we're looking at it today from a level that's high based on a leverage requirement that's also uniquely applicable at the GSIB IDI level, which is just not aligned with the general framework that we currently have. And so it is important to balance what's at the holding company, what's at the bank. And I was expressing earlier, I think this rule would strike a better balance, but that doesn't mean that going lower is forever going to be a better thing. It's that it's necessary to balance all these things. So it's that this rule strikes a better relationship with the broader framework, in my view.
Okay, I'm watching for hands. I'm also watching the time. We have a couple more minutes.
This is the final line of
now Al.
defense. Hold it
Sure.
at all
Thank you.
costs.
Al Moffat, JP Morgan Chase.
There's nowhere to reach.
So, there's been a lot of discussion
Don't let
today,
this sector
about the
fall.
role of the leverage ratios in the treasury market.
Artillery barrage ready.
And so one of the things we saw
We held on to the critical objective.
was that there was significant deposits prior to the rolling out the overnight RRP program. And strikes me that the changes to the leverage ratio may, reshape that into a potential next crisis. So I'm just wondering if the panel has any thoughts on the role, particularly the value of changing the SLR for the IDI and the consequence on deposits and other low-risk activities like that, even if they are put into cash and not 30-year Treasury bonds. And just maybe that potentially offers flexibility for the Federal Reserve.
Enlisting artillery barrage!
Artillery barrage incoming.
I was going to say the economic analysis of the proposal makes very clear that just in the past years and probably over longer periods, the degree of low-risk assets, treasuries, reserve bank deposits are much higher now than they've been in historical past. And I think that's important for the ESLR. It's also important for the basic Tier 1 leverage ratio. They have 4%, 5% structure in the Prompt Corrective Action Framework. It's been around for a very long time. When it first was implemented, I'm very confident that reserve bank balances and treasuries were a much smaller portion of bank balance sheets. Thinking about the overall structure of the capital framework, looking at the evolution of bank balance sheets, the degree of low-risk activities that are related to deposit taking, liquidity risk management, I think it's a very important consideration.
Artillery barrage ready.
I agree. As you mentioned, Al, heightened cash balances and deposits, particularly in a period of stress, typically coincides with when also Treasury intermediation is important. But ensuring, which is why we talk about a targeted approach that specifically excludes cash, for example, because banks tend to be that shock absorber of cash and deposits, whether it be in the immediate stress or afterwards as a result of monetary or fiscal policy. And banks having the ability to support that in periods, particularly volatility or stress, is important. And I agree that both supplemental leverage ratio as well as the Tier 1 leverage ratio should also focus on that.
And I think, just to reinforce that, making sure the leverage ratio doesn't impede the banking system when the Fed is doing QE. Adding to those deposits that you were talking about, and that's at the Bank of England, exempted deposits at the Bank of England. So I think,
cover your ears!
So as I said, I would be opposed to exempting treasuries. I think thinking about exempting deposits at the Federal Reserve from the denominator, along with the other things, is worth consideration.
And that's a good point in that the PRA has made that exclusion as well in their leverage ratios, specifically for cash.
Good morning to everyone, and welcome
Allied
to the Federal
forces are
Reserve
taking
Board.
objective
I'm
Charlie
very
1.
pleased to
Reinforce fire support.
see such great interest in the topic of today's conference, the integrated review of the capital framework.
Strategic beacon
I
deployed.
want to thank Vice Chairperson Commissioner Bo for having a great idea for this meeting. Also, thank Fed staff for their time. Today, we hear the perspectives of veterans, academics, policymakers who are all all the different pieces of the capital framework work together.
It's our turn!
Doing so will help maintain a safe, sound, and efficient banking system for the
Stand
benefit
your ground. Defend at all costs.
The U.S. bank capital framework includes risk-based capital requirements, leverage requirements, the surcharge for the largest and most complex banks, and the stress tests. We will discuss the status of each of those elements and the road ahead in a comprehensive manner.
This is our last
Audience
position.
know well,
Secure
we
it
have
at all
proposals
costs.
outstanding or in the works across all 4 areas.
Secure our last
Our regulatory
sector,
capital
whatever
framework
it
and
takes.
all banking rules are implemented through supervision, an area where Vice Chair for Supervision Bowman brings deep experience as a former banker and state supervisor. As she has noted, we need to make sure that our supervisory practices focus on the critical areas that determine safety and success. We need our large banks to be capitalized and to manage their key risks. And we need large banks to be free to compete with one another, with non-bank financial institutions and with banks in other jurisdictions to provide capital and support economic growth. The Fed is a dynamic institution. We're open to hearing new ideas and feedback on how to improve the capital framework for large banks, and I look forward to hearing from today's participants. Thanks again to all of you for joining us today. Thank you.
Charlie 2. Let's go for the next objective.
They had this leverage requirement, and it was their finding fault with this leverage requirement that actually led us.
Allied forces are taking objective Charlie 1.
So, indeed, with the introduction of Basel's risk-weighted banking agencies intended that risk-weight standards, not the leverage ratio, would take over as the primary determinant of a bank's capital. After the financial crisis, the largest banks were then subjected to the supplementary leverage ratio, and in the case of GSIBs, the enhanced supplementary leverage ratio, ESLR, which is a more stringent
We have lost
version
all
of the
sectors.
SLR.
Operation failed. Extract immediately.
Importantly, when the banking agencies implemented Basel I's risk-weighted standards in 1989, most commentators argued that the leverage ratio should be dropped because having 2 separate sets of capital requirements would be duplicative and unnecessary, and the risk-based one was better than the old leverage one. And the agencies seriously considered doing away with the leverage ratio, but they ultimately chose to retain it. They were not confident in the accuracy of the novel and untested, then, risk weightings. And at the time, risk-weighted standards only accounted for credit risk, not market, operational, or interest rate risk, which was also an important part of thinking about bank capital. But we're far along now in the process. Here we are in 2025, and risk-weighted standards have evolved during this period of time. They have since their beginning been supplemented to incorporate market risk and operational risk, and now incorporate complex modeling that did not exist at the time of Basel I. Moreover, interest rate risk is continually monitored by bank examiners as part of the supervisory framework and could be incorporated into risk-based capital if you wanted to do that. We also have several other safeguards in the capital framework that did not exist at that time, like the stress testing regime. So there are strong arguments that the concerns that motivated the retention of the leverage ratio have been mitigated by subsequent enhancements and refinement of the overall capital framework. The leverage ratio is now a frequently binding requirement for the largest institutions, meaning that it requires more capital than the risk-weighted standards. This is inconsistent with the agency's original rationale for retaining the leverage ratio, which was that it would sort of be a backup for the insufficiency of the risk-weighted requirements. Bank capital levels, in conclusion, Harold, are at all-time highs now, well above what Basel and other jurisdictions required. I think we need to step back at this point, which is the whole purpose of this conference, and ask ourselves, with respect to the leverage ratio, not only focus on ESLR, but whether we need it at all. Thank you.
Thanks. Does anyone want to react? What about the issue of intersecting types of capital requirements? Does that cause problems when different banks are subject to different rules at different times? Any views on the panel?
Well, I can offer two observations about the role of the leverage ratio in the broader framework. One is just, I know this conference is primarily focused on large banks, but we do have the community bank leverage ratio for smaller community banks. So there can be benefits in having a leverage ratio for particular institutions. They could have a simpler framework. But I think also the fact that the leverage ratio is itself simple also illustrates one of its potential benefits. I mean, we've seen in stress periods, there's often a focus on simplified metrics. That was certainly the case during the financial crisis. To some extent, it was also the case during 2023. It wasn't necessarily the leverage ratio that was a focus, but there was a focus on things, metrics such as tangible common equity or others that are simple. So the simplicity of the leverage ratio, if it's properly designed and calibrated, could play a complementary role both for smaller banking organizations if they wanted to have a simpler framework versus the complexity of calculating risk-weighted assets, but also more generally to have a component of the capital framework that sort of the benefit of it is its simplicity, particularly in times of stress.
There's also the issue of assets that turn out to be more risky than they're modeled to be. And this is a backstop for that. So the obvious example from history is AAA subprime mortgage tranches, which weren't really AAA, but were modeled to be AAA, and capital held against them, and it was a disaster.
Yes, Brian.
I might just add when you look at 2023, leverage requirements didn't necessarily catch the buildup in what seemed to be risk-free assets in some banks that ended up having trouble. So I think the important thing is, as Ben said, properly calibrated. And it's difficult to perfectly calibrate a risk-based or a leverage requirement in advance. So I think vigilance and staying on top of risk is ultimately the key. You can't just rely purely on either of these. There's constantly new risks emerging. Something like CRTs, certainly growing
As
in
I
use.
lay here on a
Very
stretcher,
well, just,
I'm reminded of my
great
first
disclosure around it.
encounter
It's
with
just
the true
staying on
face
top
of
the
war.
risks that come on this.
I had just arrived on set to film a
For the
reenactment
backstop,
when we found ourselves
principal.
swept into the
Tiffany?
middle.
If I
of a
can
real
add to
battle.
that, the leverage
first, I thought it
ratio
was
is
part of the
one piece of the
performance.
puzzle.
But
So
when blood from
banks
a
are
nearby
managing
soldier
to
splattered across
capital,
the camera
interest
lens,
rate risk, liquidity,
I
and all
realized
of
the
those
shocking
as part of a
reality
holistic risk
of the
framework
situation
is
in
important.
Asara.
I think about stools on a table. Each leg needs to be strong. And so to Brian's point about interest rate risk management, that individually also needs to be a robust leg to keep the entire table stable. But the leverage ratio itself can't overcompensate and make up for any weaknesses in other areas of risk management.
Al, did you want to react to anything, any of the reactions to your comments?
No.
Secure and hold the beachhead. Let's go, team.
I sense a degree of alignment with the panel on this. Okay, Tiffany, you're the treasury market expert. And as I mentioned, there's been a big focus on the unintended consequences for the treasury market of this rule. Some regulators have cited the fact that treasury market functioning as a key reason to recalibrate the leverage ratios. But is it better to lower the leverage ratios embedded in SLR or SLR and the Tier 1 leverage ratios? Or would it be better to have a more targeted fix to address treasury market functioning, like exemptions?
Thank you, Daryl. And let me kick off by thanking Vice Chair Bowman and the Federal Reserve for bringing us together today on this important topic. Let's spend a moment on Treasury market functioning. As a treasurer, that topic is so critical. Use treasuries for liquidity management, collateral hedging, and it's all linked to the treasury market being the biggest, deepest, most liquid bond market in the world. Stands at close to $30 trillion today and growing. So supporting a resilient treasury market is important for the broader financial system, which we're all invested in. There are two key tenets to that. One is safety and another is growth. In terms of safety, there are a range of enhancements already in flight, including the central clearing. In terms of liquidity, supporting and deepening the market for treasury securities, which is growing, is critical. In our seat, knowing that a treasury security can be converted to cash easily, quickly, and in all market environments is so important. And that's all predicated on an ecosystem of buyers, holders, sellers, intermediaries. And the intermediation of treasuries is particularly important in periods of stress. At BNY, we have a unique vantage point into the treasury market, and we do see elevated treasury volumes in periods of market uncertainty or stress. In those periods, the market is operationally resilient, but we have seen periods of funding market pressures or dysfunction. And that tends to stem from an imbalance of buyers and sellers in the market. So it is exactly in those moments where having intermediaries who are ready, willing, and able to support the treasury market and the continued liquidity in the market is most critical. So that brings us to the topic here today, leverage reform. Leverage ratios across the supplemental leverage ratio as well as the Tier 1 leverage ratio in their current construct can disincentivize banks from intermediating treasuries during those periods of stress, exactly when it's needed most. And another dimension to this is typically in those periods of volatility, there is also heightened balancing of cash or deposits on bank balance sheets. So banks' ability to act as a shock absorber for both cash and treasury securities can be constrained by leverage ratios. Now, the proposal offers solutions to that, and there are a couple flavors to that, and there are considerations for each. One flavor is to lower the overall leverage requirement, and that does create extra capacity for banks. However, banks still have the discretion on how to use that capacity, and it may not be there in a period of stress. Another flavor is to specifically target cash and treasury securities and exclude those particular assets from the leverage requirement. And in that case, it's a more direct support for treasury intermediation and for banks to act as shock absorbers for cash.
We have enough forces left. Keep pushing and breaking through
I'll
the
posit
enemy
that
defense.
leverage reform is one facet of a multifaceted approach to support market liquidity. It really goes in harmony with public and private solutions, including government facilities, such as the discount window and the standing repo facility, as well as private solutions, including recent innovations such as early morning repo or Friday repo. So taken together, as I take a step back as a treasurer, every day we're focused on resilience and we're managing a range of risk measures: capital, liquidity, interest rate risk, just as I mentioned. And that's just to name a few. And we're thinking about a wide range of scenarios. We like to say, better to prepare rather than predict.
Climb the spire
If I
and
extend
neutralize
that
anyone who
lens
stands in your way.
and having reforms that are also supporting resilient treasury markets in a range of scenarios, that really leans towards taking a holistic, proactive approach, looking at all banks and targeting the risk at hand. And that'll help us target a future shock, because we all know that no two stresses look exactly the same. And so with that holistic and proactive approach and discussion is exactly in the spirit of this dialogue today.
Thanks, Tiffany. This issue of exemptions for certain safe assets versus lowering of the leverage ratio number itself came up at our committee last night, and there was a range of views, but rather than trying to review those, I'd like to get the views of our panel. So, how about a quick run of the panel on whether exemptions, in addition to or as an alternative to the proposal, would be beneficial overall?
So I would be concerned about exempting treasuries because of the interest rate risk that could be encouraged. Banks would be encouraged, I think, to take with just exempting treasuries entirely. Now, I like the alternative in the proposal for exempting treasuries in the dealer that are on the dealer's books that are marked to market and subject to the market capital requirements. Just
We have taken objective
blanket
Bravo 1.
exemption of treasuries would raise other issues.
just say, while the proposal creates significant capacity today, there could be future states of the world where ESLR became binding again, at least on some banks. It would be helpful to have something countercyclical to offset that trade.
Hal?
I prefer the approach that was taken rather than exemptions, but I would say with respect to any of these proposals, we need better data on exactly what the impact of them would be on liquidity in the Treasury market in a crisis, given the fact that the dealers only account for, not the lion's share of this market to start with.
And Ben?
In terms of specific exposure exemptions, I think it's important to think about that in the context of the broader framework. We discussed earlier the fact that under the narrow exclusion, there would still be the market risk capital requirements, but also there are many other aspects of the regulatory framework, and also many aspects of the supervisory framework. So looking at what else is there to address the concerns if there might be exemptions for specific exposure. It's more of a whole.
Again, has been able to get much disagreement. There was an intriguing remark last night at that argument table on the implications of exemptions for Treasury securities, which is that in the international financial stability framework, some other countries might be tempted to also depart from the general spirit of the SLR, exempt their own government securities, and in some cases that might have adverse implications for international financial stability. So I'm going to turn next to Brian, and I want to address the issue that's come up already, which you mentioned, which is resilience. The resilience of the Treasury market to events like March 2020 have been more prominent in the interagency working group papers on Treasury market reform than everyday liquidity. Do you think the proposed reduction in the ESLR is likely to improve Treasury market liquidity on normal days? Would the proposal improve Treasury market liquidity during a crisis? Is there an advantage, and I think you alluded to this a moment ago, to waiting for crisis conditions, as in March 2020, before lowering or exempting from the SLR?
Yeah, great. Thanks, Daryl. Also, thanks for having me here to speak today. I appreciate it. So I'd say Treasury market liquidity today, normal times, is generally working fine. You could look across a lot of measures, on the run, off the run, spread, market depth, swap spreads, futures basis, all kind of operating fine today. That said, banks are economic actors, and to the extent there was client demand and you had a significant increase in leverage exposure capacity under the proposal, then I think at some of the GSIB there could be incremental capacity deployed to low RWA activity, which could on the margin improve liquidity on a normal trading day. I wouldn't expect banks to go out and buy a bunch of long duration for their banking book, but think client financing, client intermediation. In terms of the second point around crisis, you mentioned March 2020. I think that's a great example, right? It seemed like balance sheet constraints were contributing to a deterioration in market liquidity, and regulators stepped in, much to their credit, and provided temporary relief, and that helped facilitate a return to activity. So I think a SLR that is not regularly binding certainly could and should help reduce the likelihood of a dysfunctional Treasury market in periods of stress. That said, it's just one piece. Daryl, I know you've written and testified about a bunch of the other pieces, so it's not just one silver bullet, but I do think it would be a helpful part of that process. And then in terms of that final part about is there advantages to kind of acting before or waiting, I do think it's helpful to have some countercyclical part of it. There's different ways to do that. There's the narrow exemption in the proposal. I think the Basel standard allows for exempting reserves in certain situations. Both of those have some advantages and disadvantages. You're picking winners and losers between low RWA type activities, which can cause some market distortions. You could bucket all low RWA activity together and present that as a group. Follow the rules, change the requirements. There's different things to do there. You do a counter-cyclical buffer, or just wait for the next crisis. generally, I would say the market doesn't like uncertainty, and generally, I would say it's not great policy to be working on emergency measures. So to the extent that that path could be explained in advance, the market could discount it in advance. I think it would be the market.
How about some more views? What about this countercyclical approach? Should the agencies keep something in their back pocket ready to bring out during a crisis, or should they try to fix it once and for all? Anyone have a view on that? Tiffany.
Thanks, Gerald. I agree with Brian. Clarity and having the certainty in regulations is important, particularly as we're managing our balance sheets and things. You talk about looking at various different scenarios and preparing for a range of outcomes. In those scenarios, we're typically not assuming change in regulatory requirements. And banks may take action, reduce activity in advance of a stress, expecting no changes. So the structural permanent changes, the advance notice of that, helps steer and incentivize right behavior in advance of stress, and then reduces the need to make any adaptation during the stress period.
I've been a fan of countercyclical capital buffer across capital needs, risk space, and leverage. Applied it at banking, and actually, I can't remember whether it was applied leverage ratio. I think a key, and I've advocated it and been rejected by the Federal Reserve many times. It's a moving position. But I think the key is it's not just a one-way street that you have something you reduce in hard times. You have to make sure it's adequate in the good times, that you've got the capital high enough, and that you release capital in bad times, and you control the space, that the banking system is still in both directions.
Oi! Need a hand!
Views?
Someone help!
I'm going to move on and ask Ben a question. So Ben, the Federal Reserve Board staff has estimated a $210 billion decline of capital at the GSIB depository institutions. But does that matter for financial stability given the much smaller $13 billion projected decline in capital at the GSIB holding companies? What are your views on that?
Thank you very much. That's also great to hear. When considered in the context of the broader large bank prudential framework, I think the financial stability implications of the difference are potentially positive. This is particularly the case in light of the GSIB resolution planning framework and the GSIB single point of entry resolution strategy, as well as the design of other Dodd-Frank Act enhanced prudential standards which focus on the holding company. The risk-based requirements are higher for the holding company than the banks, as you mentioned. And this reflects the fact that the GSIB circular and the S&P applied only at the holding company level. That, in turn, is itself illustrative of a key structural feature of the current large bank prudential framework, and that's the focus on holding companies. This is codified in Section 165 of the Dodd-Frank Act. Many hallmarks of the current large bank prudential framework are all holding company standards. Some examples would include supervisory stress testing, CCAR and limit stress capital buffer, internal liquidity stress testing, selective lines of and then the joint FDIC and Federal Reserve resolution plan. The proposal explains that it would do three main things. First, restore the ESLR to a backstop. Second, address the level and marginal regulatory incentives regarding low-risk return and high-risk activities. And third, provide the GSIBs more flexibility in the allocation of capital. But I think the proposal actually do three things beyond that. First, it would address the arguably anomalous role of the 6% bank ESLR. That's a bank-level capital requirement that's capitalized, that's calibrated to be higher than for the holding company based on the GSIB status of the parent. It's actually the exact opposite structure of the GSIB itself, of course, applies to the holding company. Second, there would be more consistency in the overall design of prudential standards with a focus on the holding company. And third, there would be more alignment with the resolution planning framework, in particular the GSIB SPOE resolution strategy. Under that strategy, in the event of failure, only the top-tier holding company would enter insolvency. The subsidiaries would be that strategy depends on flexibility. Liquidity subsidiaries based on their needs and resolution available resources. The strategy, of course, also depends to some degree on repositioning, which entails having some capital liquidity already at the subsidiary level. So the proposal would therefore have greater consistency with the structural focus of the holding company. There'd be more alignment with the resolution strategy for GSIBs. From that perspective, there'd be perspective and have reduced fragility and stress, promotion of the resolvability of GSIBs, and therefore positive financial stability implications.
Thanks very much, Ben. What about other reactions? Is the fact that the dollars of reduced capital at the holding company is small relative to the depository institution, is that important? Is there sufficient flexibility in capital in the structure of a bank holding company and its subsidiaries? What are your views? Hal, do you have a thought on this?
Capture the last
Do you have a thought
sector.
on this, Hal?
We're going to win this.
So, as you said, Daryl, the reduction at the depository level was much higher than the reduction at the holding company level. But I think we need to keep in mind the basic framework in which the holding company of a bank has to serve as a source of strength for the bank subsidiaries. So even though you are reducing the capital level of the depository institution subsidiaries, you have the holding company still with this obligation to support the subsidiaries. So I'm not that concerned because the holding company capital is not being reduced by the
Don?
I agree. The fact that the holding company capital is basically unchanged is reassuring. I do wonder about the source of strength. I mean, once the capital is upstream from the depository to the holding company, downstream to the broker-dealer, or if it's not downstream to the broker-dealer, it won't do any good, right? So presumably,
that was close!
Then you have a crisis. You have something happens that no one's anticipating. Are they really going to take the capital back from the broker-dealer and give it to the institution? In 2008, the board was asked to vote several times on exemptions to upstream capital from the bank to the holding company to support. So I think we need to think more carefully whether the holding company would be actually a source of strength.
What there is here?
I think that all holds together to the fact that each bank is managing to multiple risk measures, capital being one, but liquidity, interest rate risk, and other measures will also support both the IDI as well as the holding company. So all of those various constraints ultimately inform how much could potentially be upstream or where additional constraints as part of a holistic risk framework.
Yeah, I would just add, to that point, the resolution framework for single point of entry is meant to capture sufficient liquidity and capital at the intermediate holding company to avoid the situation that Don is talking about. Can it effectively do that? It's not clear, disclosure is not great in that area. It's another area where it might be helpful to have more robust discussions around that to give more confidence to more participants that actually could work.
And that's about resolution. So you're in a situation where you're managing the failure. So it would be nice to prevent the failure.
Ben, did you have a remark on that?
My only observation is I did refer to reducing fragility, and that's part of the benefit of potentially having greater flexibility. And implicit in that reference to fragility is the possibility the point of non-viability is higher 2015 2008. So that's again a reason why it's beneficial to consider the capital framework alongside the resolution.
Don, I want to turn less to you. You have been an advocate for reducing the SLR in order to make sure that it remains a backstop, as we discussed, and doesn't impede the willingness of dealers to make markets in treasuries, as you've also discussed. But you've also noted an important caveat, that any adjustment does not reduce resiliency of the banking system. So when you look at the agency's proposals, how does it stack up against these criteria that you have in mind?
Thank you, Darrell, and thank you for inviting me to be part of this. You're right, I've long supported enhancing Treasury market liquidity by making the SLR a backstop. In fact, a senior Federal Reserve official told me a couple years ago using too much leverage ratio. Grateful to have that space freed up for something else. But as you noted, my support has been couched in the context that it not reduce overall
One
capital
objective
requirements
left.
and
You're almost there.
And I think I take quite a bit of comfort in the fact that there's been no reduction in holding from the holding company level. But I do think, as I just noted, there are things we need to think about. And I still have a few concerns on this overall resiliency issue I'd like to surface, and I hope come up in agency's consideration.
We have enough
First,
forces
obviously,
left.
making the
Keep
SLR
pushing and breaking
backstop
through the
puts
enemy
extra
defense.
pressure on sound risk-based capital requirements. And I think financial sector resilience is especially important right now. The economy could well be on track
There's nowhere else to run. Final
for
push.
growth and low inflation. That's what's priced into financial markets. But we shouldn't Secretary Bessent last night worried about pro-cyclicality in financial markets. He cited private credit in that regard. But we know banks and bank regulators, from history, we know bank regulators are not immune to this. And the tails of the distributions around the central tendency seem unusually fat, as we are in uncharted waters with respect to the evolution of the global trading system, the ratio of national income, the challenges to the independence, the risk of unanticipated developments. And it would be preferable to evaluate this proposal as part of a holistic review of all capital requirements, and I suspect this is putting all this together. There's so many in the risk-based capital. There's the Basel III Endgame GSIB requirements and the stress tests, and how are they all going to fit into this? So were risk-based capital requirements the first line of defense weakened?
This is their last stand. Take the sector.
For reducing
Guided missiles lost.
the whole package together. And the second point releasing capital that the DI will not reduce the organization, but it will be encouraging. In fact, one of the
Victory in sight.
benefits
They can't hold much longer.
securities, so it does expose them to added interest rate risk, widespread losses on Treasury and agency securities contribute not only SVB's problems, but the risk to the broader system that triggered extraordinary actions by the authorities in March of 23. So banks should be required to mark securities in the available for sale portfolio to market, and the available for sale portfolios should be subject to market.
This is their last stand. Take the sector.
Interest rate risk management, even for the big maturity portfolio, will be subject to close scrutiny. Concern about this would make me very reluctant, would make me opposed to exempting all.
This is their last line of defense.
So the gist of your remark is that you want to see the whole package, the final view on it. Yeah, interesting. And other, Hal, what's your view on this?
So I think we need to keep in mind that the U.S. banking system is today very well capitalized. The U.S. GSIB actual capital levels have increased 17% over the past 2 years, and our minimum capital requirements are now 1.7 times higher than the Basel requirements, 837 billion versus 473 billion. Under Basel, because of our stress testing regime and gold plate. We gold plate the Basel requirements. This proposal does not reduce risk-based capital. It merely moves leverage into the background where it always has belonged, and in my view, we could do away with, okay? And if it's in the background, you can further say, why do we need advantage? We're going to So, anyway, I think overall the U.S. banking system is in a very good place today in terms of its actual capital.
Hal, you mentioned gold plating. I'd like to get a reaction to something that came up, another topic that came up at dinner last night, which is the implications of the SLR and other regulations on the ability of U.S. banks to compete both with non-bank financial institutions and with international banking institutions. First, is that competitive angle,
Allied troop force left. We must pick up the
does
pace.
it figure in your minds as an important aspect of the rule change? And secondly, is it actually true that U.S. banks have been at GSIBs have been at a competitive disadvantage because of the capital requirements that we've been discussing?
Quite frankly, don't know the answer to that, but I would be skeptical. I think there are a lot of other factors that affect competitiveness. I mean, when we originally adopted Basel, it was because of competitiveness concerns with the Japanese banks, right? And we said, well, get them on an even playing field. They have different government subsidies. They have different forms of regulation. They have nothing to do with capital. So you have to add all of that into the picture when you're thinking about competitiveness.
Any other reactions on competitiveness? Ryan?
I would just say certainly we have a higher SLR requirement than other jurisdictions, although that does not seem to have stopped our banks from competing very well against a lot of the international banks.
Roger that.
Certainly
Artillery barrage incoming.
Increase their scale and scope.
Guided missiles launched.
Moderators don't get to vet their own views, but it does seem that better capitalized banks are better able to compete.
Guided missile ready.
I don't think the UK, European, Japanese banks would think that they're at an advantage because they're competing very, very well.
Artillery barrage ready.
When being well capitalized. That in the U.S.
Victory in sight. They can't hold much longer.
Regional banks, people were concerned about the embedded losses on treasuries and other things, and they fled to the GSIBs. Some of the commentary, well, that's because the GSIBs are too big to fail. But I think it was also because the GSIBs were much better capitalized.
We need to take it down. Capture the last sector. We're going
One observation,
to
just do receive a lot of questions about the regulatory capital or liquidity treatment about extensions or things of that nature. It does clearly illustrate that there are marginal incentives and essentially marginal capital cost, liquidity cost does factor in. That's not necessarily contradictory. The actual marginal effects of regulation do factor into business decisions. And there are differences between U.S. and non-U.S. requirements.
Tiffany, at a global bank.
Well, I was going to re-highlight some of Don's points. One being completely support interest rate risk management, strong pillars, important risk pillar that mentions an important part of the overall risk management framework for banks. Second, the holistic review is an important point as well, because we find that, again, managing with a lot of risk measures, making a change to one risk measure likely to have another become binding over time and could have the same constraints in the market. So I think that holistic review is also
Okay, I think we got a pretty good sense of the views of the panel, and I think it's time to turn to you all. If you have a question, Would you raise a hand? I see there are microphones. Would you also please identify yourself and try to keep it to a question, just one. If we have a second round, we can come back, and not a speech, just a question.
My name is Vua Bă. I'm in Sitma. My question is, as you know, currently category 1, 2, 3 banks are subject to 2 leverage ratios. One is supplementary leverage ratio, the other one is Tier 1 leverage ratio.
We have marked a high-value objective.
Why do
Take
you
it
think
quickly and push
ratios,
forward.
both target leverage, are needed for these banks?
Okay, I'm going to ask anyone who can address that question, because I don't want to handle that one. Hal, do you have a thought on it?
Victory in sight.
I'm
They
not
can't hold much longer.
two ratios, and I disagree with both of them.
Okay. I'm watching for hands. Yes.
15% troop force. Time to make our final stand.
Hi, Sharon Shai from Morgan Stanley. Actually, a question directly to Don. You mentioned that you think that we should have a countercyclical buffer. You mentioned overlap between different parts of the capital regime. You mentioned that it was something that made sense in the UK, but at the same time, the US has a much different capital regime, inclusive of the CCAR test, for example, which does give you an ability to build capital, to be there for space. And so I'm curious as to why you would want to impair potential use of capital from the banking institutions in a period of stress where they could be used.
This is their last stand. Take the sector.
So it's almost as though the concept behind overlap is not necessarily taken into account buffer mentality, where you don't necessarily have the CCAR exam in the UK.
Yeah, so I certainly think there's simplification and the 2 leverage ratios and overlap between things. That's why there's
some research, for example, by Paul Groening and Hilary Stein at the Federal Reserve Bank of Boston, showing that those dealers that were relatively more constrained by SLR provided relatively less liquidity to treasury markets in the March 2020 event. And more recently, the Federal Reserve Board study by Mary Tian and her co-authors showed that those banks that had more headroom under the supplementary leverage ratio provided more financing in the treasury market. So there is some research to support that.
Fail to break through enemy defense. Fall back.
Daryl?
Yes, Hal.
So I understood the question basically was, let's get rid of the Volcker rule so we can have more prop trading that could actually help the treasury market. Fine. It's the implication. Okay. So, I understood why we did have the Volcker rule. It was kind of a populist measure back at the time when Scott Brown got elected.